Welcome back. You're still watching Market Cafe right here on ET Now. Let's move on to a big update that came out yesterday, a big blow to Moodynomics, US-based credit ratings agency. Moody's has cut India's GDP growth forecast for 2018 from 7.5% to 7.3%. Agency strongly believes higher oil prices and tighter financial conditions will weigh on the country's economic recovery pace. The agency warns the ongoing transition to the new GST regime may hamper growth for a few more quarters, which will lead to some downgrades. However, agency cheers Modi's historical reform like IBC and retained GDP growth forecast for 2019 at 7.5% on the hopes of accelerated rural consumption due to higher minimum support prices and normal monsoon. Overall, on the global front, Moody's believes emerging markets will grow at a moderate pace. Let's take this chat a little bit forward. Joining us now on the phone line is Diron, the Managing Director, Sovereign Risk Group, Moody's Investor Service. Hi, Marie. Thanks much for taking time out. You've highlighted three concerns. One is the high oil prices. Second is the rising financial market stress in emerging markets, and also the trade tensions between the US and China. Could you tell us what is your outlook on these concerns, and do you see further escalation of all of these challenges?
Yeah, so these are what we see as sources of downside risk to that baseline forecast. And to take them in turn, maybe starting with the financial market turbulence that we are seeing at the moment, we think that different economies here have very different exposure. And the ones most at risk are the ones that are reliant on external financing. And we have seen the more pronounced market movements for Argentina and Turkey, for instance, in the G20, which reflect some of the vulnerabilities, some of the reliance on external financing that these economies have. In Asia Pacific, interestingly, we think that the reliance on external financing is less. In the case of India, it is not an economy that relies on external financing. On the contrary, the financing is really sourced domestically. So that provides some shelter, some buffer against these type of market movements. And so we think that overall, the Indian economy will be resilient to a period of global financial market volatility. As regards tensions between the U.S. and China on trade, we think that this is an ongoing question, but the discussions will probably last for some more meetings. And the risks there are twofold. One, that this uncertainty about potential outcomes starts undermining investment globally in China, in the U.S., but also potentially in other economies. Two, if indeed some measures were to be implemented that impede the trade flows, that really significantly clamp down on trade flows, then that would be negative, in particular for trade-reliant economies in Asia. We think that this is really a downside risk. It is not our baseline at the moment, and we'll continue to monitor the negotiations.
Marie, and what's the level of oil prices that you're assuming for oil for global growth as well as for India? With oil at $75, a little, in fact, more than that. What is the level of prices are you comfortable for specifically for Indian market?
The oil price has an impact in different ways. One is that to the extent that it's passed through to consumer prices, it potentially raises inflation, and India is an importer of energy, and that could have a negative impact on purchasing power. We have factored some of that in based on the basis of really recent developments. Overall, though, we do expect consumer spending to remain robust, helped by a relatively favorable monsoon, or at least a normal monsoon, as well as the minimum support prices that were announced in the budget that should help rural consumption in particular. Oil prices also have an impact on India's balance of payments. India imports energy, and so with a higher oil bill, that the trade balance, in India's trade balance, moves towards larger deficits. There again, we have factored that in, and we do now expect a somewhat wider current account deficit than we did previously, around 2.5% of GDP for the year. this still remains a lot narrower than we saw, for instance, in mid-2013 when India was identified as one of the more vulnerable emerging markets. At the time, the current account deficits were running at around 4 or 5% of GDP. And so we do think that some structural change, some long-lasting change has taken place, and that India was still exposed and still affected by higher oil prices is less so than it was a few years ago.
Marie, before we let you go, we'd like to know your view on the Indian macros and how you are seeing them improve. We're expecting the Q4 and FY18 GDP as well as fiscal deficit data for India. What are your expectations, and what are some important factors that you would like to keep an eye on?
We look at monetary policy with the lens of whether monetary policy is effective in meeting its objective, and so that is whether it's effective in delivering stable and moderate inflation. And so far, we have assessed that the RBI is broadly meeting these objectives. We've seen inflation come down over time, and inflation can come up in certain periods of, say, higher oil prices, for instance. That's what we would expect for India. But overall, what matters to the sovereign is really the medium-term prospects of moderate and stable inflation that we think remain.
Thanks, Marie. Great chatting with you and getting your perspectives on how you are reading into the oil market, and what are some important factors that you would keep an eye out for as far as Indian GDP and fiscal deficit performance goes. Meantime,